Hi, in this lecture we'll be discussing the differences between accrual and cash accounting. Now, both of these are used around the world, but accrual is more widely used than cash accounting. However, it's still important to know the differences between these two types of accounting methodologies. The first difference is that under cash accounting, revenue is recognized when it's received, and expenses are recognized when they're paid. This means that revenue and expenses are only recognized when cash exchanges hands. On the other hand, with accrual accounting, revenue is recognized when it's earned and expenses are recognized when they're incurred. This is a key notion associated with accrual accounting. So let's dive into more detail as to what it means that revenue is recognized when it's earned. What does earned really mean? So earned means that revenue is considered earned when the customer has possession of the goods sold or when the customer is able to benefit from the service that has already been rendered. So let's look at a few examples of these. Let's say that Adam sells books to Carl for $100, and Carl promises to pay after 10 days. In this case, should revenue be recognized? Well, yes, under accrual accounting, revenue is recognized. Adam has earned the revenue even though he's going to be paid later. It's because Carl has possession of the books and Adam has fulfilled his end of the bargain. Therefore, he can recognize revenue and it's considered earned. Let's look at another example. Eric cleans David's yard and David promises to pay later. In this case, revenue can be recognized by Eric, as David is able to benefit from Eric cleaning his yard, and Eric has performed his end of the bargain. Let's look at expenses now. Let's say Forest Company charges Rain Company $100 for shipment of goods, and that Rain Company will pay a month later. In this case, Rain Company has incurred expenses and has to recognize them, worth $100. Even though Rain Company has not made the payment yet, it's been charged for the expenses, and it still has to pay for the expenses later on. It has a legal obligation to pay. And in this case, expenses are considered incurred because the company has been charged for it. Let's look at another example. Let's say a phone bill of $60 has been sent to Road Company for services used in this month. In this case, Road Company has to recognize the expense of $60 even though the payment's going to be made later on. It's because Road Company has been charged for the money, and it's for the money for a service that has been provided by another company. And because it's been charged for the service, the expenses are considered incurred and should be recognized. How about for cash basis? Well, under cash basis, the main notion is that revenue and expenses are only recognized when cash exchanges hands. So what does this mean? Well, let's look at an example. Let's say David sells apples worth $100 to Bob on May 1st. David receives payment for the apples on May 10th. Under cash accounting, revenue would only be recognized when cash is received by David. So in this case, revenue would not be recognized on May 1st, but instead would be recognized on May 10th under cash basis, because it's on May 10th when David receives the cash. It's important to keep in mind that under cash basis, revenue is only recognized when cash exchanges hands. Thanks for watching, everyone. Make sure to subscribe, and I'll see you next time.